Looking for a fast-charging, ultra-responsive stylus for your iPad? Meet the 2X Fast Charge Active Stylus Pen, designed for 2018 to 2025 Apple iPads. Take your creativity and productivity to the next level. Click the link in the video description to shop now on Amazon.
Welcome to Google Trends Hub, where we dive into the latest tech news and trends that are shaping our digital world. Today, we're talking about Google's massive investment in data centers and its impact on the company's balance sheet. So, what's going on with Google's $75 billion bet on BitBarns in 2025? The answer lies in the company's increasing depreciation costs, which are soaring due to the rapid growth of its technical infrastructure. In Q1, Google spent a whopping $17.2 billion on technical infrastructure, with servers and data centers being the largest components. Google owns and operates 135 data centers across the world, but CFO Anat Ashkenazi admits that it's still struggling to meet customer demand for cloud services. This tight demand-supply environment means that revenue growth rates could vary from quarter to quarter, depending on capacity deployment. Now, let's put this into perspective. Google Cloud exited 2024 with more customer demand than available capacity, and that trend continued in Q1. The company still plans to invest $75 billion in CapEx this year, but expects relatively higher capacity deployment towards the end of 2025. But how does this compare to its competitors? Microsoft is planning to fork out $80 billion on new data centers in 2025, while Amazon Web Services, AWS, has pledged to outspend Google's $75 billion investment last year. Even Meta is getting in on the action, projecting costs of $60 billion to $65 billion. The tech industry is betting big on cloud and AI, but there's a downside to this BitBarn building. As Google CFO Anat Ashkenazi said, the depreciation will accelerate. This means that the company's assets are losing value faster than they're being replaced, which can put pressure on its balance sheet. Despite this, Google remains optimistic about its growth prospects. The company turned in strong financial results for Q1, with revenue up 12% year-over-year and operating profit of $2.17 billion. And with its cloud division bouncing 24%, it's clear that Google is still a major player in the cloud infrastructure market. But what does this mean for Google's shareholders? Well, as CFO Anat Ashkenazi noted, we're in a tight demand-supply environment. This could lead to variability in cloud revenue growth rates, which could impact Google's stock price. And let's not forget about the tariffs imposed by U.S. President Donald Trump's hokey-cokey-pokey policy, which could cause headwinds for Google's devices business. So, what's next for Google? As CEO Sundar Pichai said, AI is an opportunity we're excited to pursue. But with depreciation costs soaring and tariffs looming, it's clear that the company needs to navigate these challenges carefully if it wants to come out on top. That's all for today, folks. Thanks for watching Google Trends Hub.